That's right, folks. We're back. We're having a great time. Why are we back? You see Disney stock reaction to these earnings. That's right. This thing has been an absolute dog. An absolute dog. Look in the last 6 months, down 16%, but really, last year down 22. A dog, I'm telling you. Okay, we've had a great run up prior to really the last year, and then since then, the thing's done nothing. So the fact that we can finally see some positivity here, it's a lovely, lovely sight. And you know why that positivity exists? There's only one reason. I told you in what to look for with these companies. It's Disney Plus. That's all that matters. That's all that matters in this market right now. It's all that matters. Doesn't matter if they could literally grow the parks back to where they were prior to 2020. They could grow all of that back to where it was. All they still care about is Disney Plus. It's wild stuff. It's wild stuff. I mean, you just don't understand how it happens. But let's take a look at these earnings. I hope you're excited because I am. Do I got morning hair? I probably do. Just roll out of bed and we already make videos. We don't stop. We don't stop till we drop. Quarter one non-GAAP EPS of $1.06 beats by 43 cents. Would like to see the GAAP line, but we'll take a nice non-GAAP EPS beat. But I'm more of a fan of what the net income looks like as opposed to just the non-GAAP because the numbers get fudged just a little bit of fudging. No comment on that. No comment. But the revenue, oh baby, now that's what I'm talking about. $21.82 billion, up 34% year over year. This is Disney we're talking about. Now that's some recovery right there. Oh baby, they beat by $860 million. We still saw some slowness last year, but there's a reason why you see a 34% growth. It's because you see a big bump in the parks area, and we'll take a look at that as we look at the earnings report. We'll look at the distribution, obviously, of revenue, but Disney Plus, look at this, folks, $129.8 million versus a 94.9 of a year prior. That's right, 35 million added in the last year. Significant numbers, very much significant numbers. It's very exciting because this is a big metric, okay? Disney Plus subscribers is a big metric. 35 million a year is a darn good number. And last year there was a lot of negativity because they only added 2 million during the quarter. And here they go and they added right around 7 million this quarter and said, "How about you no, can't get too inappropriate here. Listen, folks, I'm not going to get too inappropriate here. You almost caught me. You almost caught me in a grossness. But you can suck on these. You can't help it sometimes, folks. You can't help it. That's what Disney said to the analyst, by the way. Just making that clear, folks. No, do not cancel me. I refuse to be canceled. I refuse. Okay. The Walt Disney Company reported earnings for its first fiscal. Oh yeah, we know that. Okay, folks. Why would you joke with us? We know what's going on here. Let's see. A very strong start to the fiscal year. Launched a new franchise with Encanto. Yes, you did. Actually, pretty decent movie. If you didn't watch the film, significant increase to the total subscription across the platform to 196.4 million when you include all of the streaming services, which is up 11.8 million. That's really nice to see, and we're going to look at that chart as well. Yeah, that's very nice. This marks the final year of Walt Disney's first century. That's interesting to say. 100 years in business. Pretty nice, actually. The history's there, folks. Revenue, we saw massive numbers, but this is a line I really, really like. Net income from continued operations. This was a huge issue last year. Only 29 million. This year, 1.1 billion. We're back, baby. Back in the Disney groove. Is that how that song goes? Folks, let me just tell you, this company's back. They're back in my good graces. I should have bought the frick out of this thing at 140, but I didn't. I messed up. Still great stuff from this company. I love to see it. The income looking good. Free cash flow. Look, let's not talk about it because that one upsets me. That's bad. It's a bad free cash flow quarter. What the heck did they spend it all on? Look at the net income. Look at the free cash flow. What did they spend it all on? We're going to take a look at that, obviously, see what's going on there. Segment results. Oh, I love segment results. I really, really do. This is, again, more seg-op income up massively, nearly 3 times as much as it was on the quarter last year. So really nice to see. Revenue breakdown is something, you just get excited. They just obviously recently redid the structure of how they do the breakdown of revenue, which is nice, but the Disney Media and Entertainment Distribution, that's quite a lumped-in category, all their media, $14.5 billion compared to 12.6. Now that's massive, 15% growth there, and really driven by Disney Plus. Now here's a massive line here. The Disney Park Experiences and Products, that's right, over 100%, doubled it. They doubled it. $7.2 billion compared to 3.5. It shows you the demand is there and people are getting out. They want to go enjoy some Disney parks and experiences, whether it be cruises, whether it be just the parks themselves. But the recovery is there, and that's quite exciting if you're a Disney shareholder. Quite exciting. I mean, and then you see this. Last year they posted a negative line on the Parks and Experiences operating income, and here they go posting a $2.4 billion. A lot of profit to be had there, where you don't see quite as much in the Disney Media segment because they spend a lot of money on content for Disney Plus, a lot. So they're going to make up for that profit loss with the park segment once they get back to really full operation. So pretty significant. Linear networks, no real change there. Right about the same. Direct to consumer, obviously this is going to be the Disney Plus and other streaming services, up 34%, really nice. Content sales and licensing was actually up 43%, so I'm curious who they sold content to or licensed to that, they're utilizing it on their platform that got them that much money. It's pretty nice to see, though. Pretty nice to see, folks. Operating loss, obviously you see the direct-to-consumer saw a little bit of an increase. They all kind of grew their operating loss there. Nothing too crazy, though. Still positive quite a bit. From a linear network standpoint, again, nothing exciting with linear networks. Let's just be clear. They're all just kind of where they're at. Domestic channels, nothing incredible. International channels, I'm not too excited. We care about the direct-to-consumer category, okay? One that actually grew. 34%, as you can see. Higher losses at Disney Plus, partially offset by improved results at Hulu. Again, Disney Plus is going to kind of undergo these things. We're talking about ridiculous spending on content. The Book of Boba Fett, you got Mandalorian, and Kanto, I bet, was pretty darn expensive. They're spending a lot of money on these exclusive content pieces. We're talking about they're spending as much or more than most of their high-budget films on TV shows. Mandalorian cost $200 million the first season. Second season, same story. These are expensive films. And obviously not necessarily offset by the cost of Disney Plus being such a cheap platform. And again, I think in the future they will grow. It will increase the price, no doubt. But yeah, I think that'll happen. We look at the subscriber numbers, paid subscribers in Disney Plus. You look domestic, grew 18. International grew 40%. Pretty darn nice. 28% in total. Good growth there for the Disney Plus platform. And that's, if you include the Disney Plus Hotstar there, there's a 37% growth, as you can tell. So very nice to see it. Espn Plus grew 76%. Now that's pretty massive year over year. I'm quite impressed. ESPN Plus has always been kind of an underdeveloped platform, and they're really kind of trying to refocus on that, and it's honestly really nice for them. From the Hulu segment, the SVOD only, showing 16% growth, really nice. Really nice to see an 8% growth in the live TV segment of Hulu, because again, as we talk about cutting the cable companies out, you use these kind of streaming services as really the next form of cable, which Hulu offers a great plan there. It's good to see growth in that aspect because it's quite the expensive plan, and that's how they're able to grow. Obviously, operating income there. Total Hulu up 15%, grew around 6 million subscribers. Really nice to see it. You love seeing it. Average monthly revenue per paid subscriber grew in every single metric besides the Hulu SVOD only, as you can tell, but every other metric grew. So really nice to see that. That's kind of how you really boost that revenue, and it helps the profit line as well. So really like to see that. Yeah, really like to see it. Disney Parks and Experiences, really love this one. Yeah, I love to see it. So, increase in operating income at our international parks was due to growth of Disneyland Paris and Hong Kong Disneyland Resort. Again, not quite at full capacity, so we'll see what goes on there. We look at this domestic. They say it was international, but look at this domestic line: 4.8 billion compared to 1.4 billion. Good grief. International grew quite a large margin here as well. 861 million compared to 378. Again, a lot of this international is not quite fully open. So once it is, you're going to see a ridiculously great line here. Excited to see. Consumer products actually decreased 9%. Nothing really crazy there. I don't know. I guess they weren't buying enough Baby Yoda stuff. But again, as more people get into the parks, you'll see more consumer products being sold. You should buy more Baby Yoda stuff. Trust me, he is the cutest thing ever. And obviously, when you look at operating income here, not really comparable because they posted negative lines last year. So, but massive growth there. Massive growth. It's massive growth. Let's take a look here. We're running a little long here, so we're gonna look at the balance sheet. I love charts, and they're just filling me with them. I'm gonna take that back right now. Total current assets. Look, I prefer a longer comparison than 3 months, but we'll take it. 32.9 billion compared to 33.6 3 months ago. Slight decrease in the cash position. Curious what the purchase was. You're always curious. Total assets in general at 203.3 compared to 203.6. Nothing really to write home about there. Total current liabilities did decline actually by a decent margin, 30 compared to 31 billion, so $1 billion decrease there. And really that's kind of carried over because the long term did not really show any increase as well. So total shareholder equity here actually increased over the last 3 months by $1 billion, 94.3 compared to 93. The balance sheet's in really good shape despite that free cash flow line, which looked a little bit rancid, but the balance sheet's in really good shape. I like Disney's balance sheet, and honestly, with the trend, this thing's looking really nice. This thing, look, at 150, it's a screaming buy to me. We're talking about a cheap forward PE ratio. Cheap. I'm just going to tell you that right now. And one that's been really a dog over the last year. I think this thing is darn cheap. Let's see that forward PE ratio here. I just want to check. Yahoo Finance, obviously not the most trustworthy. Supposedly, and I'm assuming that's as of yesterday because we haven't quite opened the market yet, we're sitting at 30 forward PE ratio. And again, that's before a nice earnings beat, so it'll be floating around there. Price to expected growth, cheap. And market cap, if you might be curious, is sitting at $268 billion after this little jolt here. $268 billion market cap for a company that, all things considered, is going to be doing right around $85 to $90 billion of revenue. It's freaking cheap, folks. It's less than 3 times price to sales. I think this is a darn cheap stock. I love it. I hope you have a great day.